Now, we were talking about some big movers, especially on the back of numbers. And, let me firstly bring on board Sunil Subramanian, who is founder and CEO at Sense and Simplicity. Great having you here, sir. And Shivangi, of course, is still with us. Shivangi, your take on a Bharat Forge, if you already haven't taken a view from you on this one.
Yes, Harsh, Bharat Forge, we've discussed. The stock looks quite positive, and we've seen that the price volume surge in today's session is quite, well. We've seen that on the weekly basis, it has, bottoming out structure, and we are expecting around about targets of 1450 on this one with a support of 1360 level.
All right, so that's the take coming in on Bharat Forge. A stellar move in today's trading session is what we have already seen. But with this, Shivangi, we let you go. So good having you on the channel today. Always a pleasure. All right, but we have Mr. Subramanian with us, so let's take the discussion forward with respect to what is he looking with respect to the markets and the move. But before that, interesting numbers coming in from Yatra, I believe. Just a while back, we had that flash coming in wherein we have seen very good set, and even the stock is seeing a very good move, almost a 13% jump is what we are getting to see. The profit has seen a surge of 94% on a YOY basis, while the revenue has seen a surge of 48% YOY. So, Mr. Subramaniam, let's start with this theme itself. Let's pick it up with respect to the travel and tourism theme. Of late, what's the sense that you are getting? Because Indian Hotels did come out with its numbers, while the management commentary remains to be on the positive side for Q3, but the stock was a bit subdued. While Yatra numbers, the stock is very, very much excited right now. There are smaller hotel plays as well. Where are you finding opportunity in this space? Is there any with respect to the valuation comfort and the growth outlook?
I think this is all a part of the discretionary consumption pack, and the fact that the GST cut. So even in the hotel industry, if you notice, I think up to 7,500 rupees, the GST has dropped dramatically. So I see value in the middle class budget hotel space rather than in the 5-star and the premium luxury spot, because that's where there's making a huge difference. And as you know, I think ever since we've seen the Kumbh Mela and the Ram Janmabhoomi inauguration, we've seen the domestic religious spiritual tourism pick up, and that's being sustained because you're seeing this all over the country. So I think the budget hotel space and all of these tier 2, tier 3 cities are seeing a huge mushrooming of a lot of hotels. And these are 3-star and 4-star. So I see that's where the big growth opportunity is, because it's a middle class which is making its presence felt with the tax cut from the government up to 12 lakhs, with the GST cuts. It's they who are now beginning to feel that I can look positively to the future and are beginning to spend money, whether it's on durables, whether it's on clothes, or whether it's on travel. So I would say that's the sweet spot, because the 5-star and above is more of a foreign tourist come business traveler. But it's the real boom in the country, I think, is happening in the mid-tier hotels from the mid-tier cities. And I think that's where a huge expansion and boom. And what's probably adding to this is the hospital space, because, along with hospitals, people who are coming in from Africa, from the East Asian countries, from Bangladesh, they all come, the families come and they need to stay. So there's a lot of really related boom and there again, it's in the 3-star and the 4-star category. So to summarize, that's where I see the spot, the budget and the slightly above budget middle class kind of mid-tier hotels and mid-tier cities.
And Sunil, just shifting tack here. You've got Britannia, where there's a huge leadership change which is at play. The kind of reaction on the counter you believe warranted from a fundamental perspective will be interesting to have your view. We've taken a technical view, of course, from Kunal earlier, but give us your sense on the fundamental. Is this as big as the street is reacting to, or do they have enough depth to take care of this void that could get created?
So I think that fundamentally its company is sound. And fundamentally, I don't think the change in the top leaderships makes that big a difference. the market tends to react to this. So it's more of a knee-jerk reaction of the market. And I would still say that companies like these, right, which are well-established hierarchical framework for doing their business. They are not one person driven. They are not a family owned business. So to that extent, I think whatever reaction in the market is there in these kind of companies, I think it's an overreaction and the fundamentals are solid. And I don't see any challenge to the fundamental outlook because of this change.
All right, so that's the take coming in on Britannia. Let's watch out for that. But one of the other strong movers is HEG today. HEG did come out with a very good set of numbers. And Kunal, the other stock which actually mirrors the move of HEG is actually Graphite India. I see that at the start of the day, the stock was quite flat, but throughout the day is also seen to be picking up momentum and even bigger gains than HEG right now. Which amongst these is looking good to you?
Yeah, so I think both of them are very high beta in nature, but both of them are showing signs of improvement on their charts on the recent basis, because HEG, if you look at the recent charts, 600-ish thereabout has been the level the stock has tested twice, and the stock has corrected sharply from those 600 levels. But it seems like that 500 mark broadly is a strong support. The 200 DM is also closer to those 500-ish odd levels for HEG, and the stock is taking support at those zones. So that becomes a territory where traders could look at a contra buy. For graphite, I think we are also seeing closer to this 450, 470 mark as a major support. The stock has bounced off from this levels twice or thrice in the last 2 or 3 months. So that seems to be a good enough support zone. But the point with both of these stocks is they are very high beta in nature, and we've seen swings of almost 15 to 20% for many times for the stock price. So that's why you have to be a lot more skeptical with respect to the kind of quantity you are looking to buy, the position sizing, as well as the entry price for the stock.
There's one stock which has taken a bit of a knock both in trade yesterday as well as today. And that one is transformers and rectifiers. We spoke with management earlier today. Sunil, do you at all look at this space, because it's currently seeing a deep gash, both transformers and rectifiers, and then there's another one called Transrail Lighting, which is also seeing pressure. Do you at all look at this space? There was some cash flow issue. The execution was a bit staggered. The numbers didn't enthuse the street. But the management came out clarifying today, saying that there's no concern whatsoever where the underlying business is concerned. This is a transformer business company. Power has seen a huge transformation in the last few years, been a multi-bagger story. What next? Is this an opportunity to buy, is what I'm trying to judge?
Well, I don't track at the micro level these companies. So I'll give you only a macro answer that power is on a good wicket. Given the country's growth and the need for power and the investment in alternative power. So obviously transmission and distribution will grow along with that. So overall, the top lines are going to grow tremendously, and the bottom lines of each company specific will of course be subject to vagaries. To me, if you have a medium-term outlook, keep a 5 to 7 year outlook on this situation, then I would say that you can keep buying on dips, but don't expect any short-term big bounces, because a lot of the story is in the price.
Today coming in on the transformer space, but with this viewers, let's listen in to what Swiggy CEO Rohit Kapoor had to say to ETNOW on their fundraising plan via QIP route and the company's growth outlook here onwards.
Look, I think the QIP is yet to open, so I will not like to get into the details of what the funds. I think those documents will be available to the public at the right time and for everyone's consumption. But overall, look, we have a comfortable balance sheet, right? But these are also times where I think the opportunities in front of us, whether it's quick commerce or some new areas, the market is still expanding. The market is really growing at a fast pace. In quick commerce, for example, is pacing 80 to 100% year on year. So in that zone where there is such a large market yet, because some people believe that India has matured. I'm not in that camp at all. I think India is really on the cusp of growth like we have never seen before. And I'm not talking next quarter or 2 quarters. I always keep saying I wish I was younger, right? Because the next 10, 20 years economically what India is going to experience is nothing like what it was in the last 20 years, which was also great. But I think the inflection is coming. So I think we are well positioned to capitalize on some of these opportunities, and we want to keep always a very healthy balance sheet to do that. Yeah.
And the food delivery business specifically, last quarter you saw 18.8% growth in GOV, quite healthy within your guidance. So, going forward, do you see it being in the 18 to 20% range as you're focusing more on the affordability part, where we see more demand than the premium parts as of now, just in absolute numbers? So, do you think you could even surpass the 20%, or how are you sort of, balancing looking at the affordability and the growth?
No, so the 18 to 20% guidance remains. But do we want to do more? Yes, right? Like any other solid company, I think we just want to grow more. And I think there's an opportunity if we can openly unlock the affordable segments in a much more decisive way. Having said that, look, the food delivery business is also very profitable. We declared 2.8% GOE as EBITDA last quarter. And that is, we've guided to a 5% of EBITDA, of GOE as EBITDA. So that journey also continues. It's a question of balancing it out and making sure that while we are making the vertical more and more profitable, we are not doing it at the expense of the growth which is available in the market. So our eyes will be on both. I think that's the job that we have cut out. Right?
All right, so that's the take coming in from the management of Swiggy, talking to us about the fundraise plans that they have declared and even received the board approval of late. And yes, of course, interesting times. But Sunil, what's the sense that you are getting on the quick commerce space right now? Because yes, of course, the competition is seen to be intensifying. What these managements are highlighting is that the quick commerce space specifically is facing some bit of a slowdown. On the other side, we have seen that platform fees going away in some of the unlisted players. So definitely the competition is seen to be perking up. And also given the fact that all these companies have already seen a very good run-up in the past couple of years, the TAM definitely has a headroom to grow. But what's the sense and what will be your advice for investors?
My advice is simple. Keep buying, stagger, but diversify. So what do I mean by this? Yes, these price valuations are quite rich, but the growth potential is also quite good. It depends on the time frame and your risk appetite. So what I would suggest is that, first of all, don't pick players, right? Buy the entire pack. If you're in that space, buy the pack. So diversify it. But do staggered, because these are also, because of the high valuations, subject to greater degree of volatility than the market. And any news flow this way, that way, anything, even macro news flow tends to affect these. So stagger your buying in this, so that you keep buying it at all price points. But like I said, buy the pack and not the particular wolf.
Sunil, do you believe that this 20-year runway, and I was reading somewhere today that Lenskart will have to grow at 18% CAGR in terms of top line for the next 20 years to really justify the kind of valuation that it has in its IPO? Are you also of a similar view that they will have to grow very, very fast for very, very long, and that's a real risk, or that could be a real risk? Because from what the Swiggy management was indicating, they were saying that India has a very, very large growth runway in front of it.
See, I think that's the biggest problem that we are facing, is that we are still using old world models to judge new age businesses. This function of taking 18 years to get to this is all because you're using your traditional discounted cash flow models, using a equity premium cost built into it, and trying to arrive at these new age businesses. Don't go by those, right? They are going to expand India's market in a tremendous way. Now, whether it grows 18% or 20% or 5%, it's not about that kind of a number. The market is going to continuously. So 10 years from now, the market will be discounting a 20-year story. So 20 years from now, discounting, when you see something which is just starting off in terms of its targeting the Indian population as a market, right, is going to not dry up in the next 5 years or 10 years. So the traditional values don't fix. So these things are all very new, and that's why the market participants are rushing over themselves to pay the premium today. It's not coming from just your old age method of evaluation. So I would rather that we don't even look at that way. Say that, is this a growing space? Yes. Is this a company geared well in an organized sector, in a largely unorganized sector? It's an organized play coming in, targeting a premium segment? Yes. Now, is that something that in India is going through from a formalization, digitalization process? Our economy is going to explode. So you can't put numbers to this. When something is going in geometric progression, we are still using arithmetic progression to kind of assess it. So I think, like I said again, in all these new age, right? I don't like to talk company specific, but build new age portfolios, diversify in all of those companies, stagger your investments because they will be more volatile. That's the simple mantra that you have to follow because they don't fit into your models. And that's why you have had big DIIs and FIIs participate in these IPOs at those valuations. Why do they do that? It's because there's a much larger story out there at play, which is a story about market expansion. It's a story about a young India growing and experimenting with new things and willing to spend. It's a story of our growing per capita income. A whole lot of things fit into it. So in an Excel model of projection, you will hesitate to put in 20% growth at any particular year. You will say, no, let me take it as 7, 10, India's nominal GDP. And that's the problem with assessing these new age companies. Now, there's no right and wrong. So market ultimately, bhav bhagwan hai, as they say in Hindi, right? It's the price which tells you the collective wisdom of the people there. Now, that could change tomorrow, so stagger your investments into it. But you have to stay invested in the new age because that's the new India. And you're going to miss out on this whole thing. Because I'm just saying that if you go back, let's say 20 years or 30 years ago, and look at Infosys as a model, did anybody predict these things happening at all? I doubt it. So I think that my answer is respect the market, but respect the fact that the market is also volatile. Hence, and don't try to pick winners because, like you said, it's a huge stiff competition there. And it's not only from the share market players. There are unorganized players, smaller players, all competing in this marketplace. So diversify and stagger. I think that's my answer to these new age.
I seem to have hit a nerve, Sunil. I seem to have hit a nerve. So, but thank you for that. Summarizes how you feel about some of these new age tech companies. What about the telecom companies? We had Vodafone come out with numbers. There's plenty happening within that basket as well. But there are just 2 or 3 ways to play that. Whether you would opt to play it or not, and if so, would you play it through the number 3 player, or how would you play it, Sunil?
Well, my answer is the same. Diversify. Don't pick the winner. Because what happens is that the loser's share price is so bad that the bounce back you will get from any improvement in his finances, operating model, anything is going to be phenomenal. Now, the point is that, so don't, in such new spaces, we have only 3-player industry there. So buy all the 3. Don't try to pick a winner. But is telecom going to expand? It's absolutely right. We all know that internet penetration and everything else is going to go. And because of the kind of oligopoly of 3 players, pricing power is in their hands. Yes, one of the players hasn't done that well, and that's why he's on the back foot. But there's a government coming and helping bail out. We don't know how the future is going to do. So don't try to pick A, B, or C. Pick all of them. Maybe you tweak the proportions in terms of what you think, but you better be present in every one of those because the volatility in these prices will be huge. And again, sorry to keep repeating like my broken tape recorder here, but diversify and stagger. That's my approach because even telecom to me is a new age business. I know it's been there for quite a while, but the way the forward is also huge in terms of this industry. So my answer is very simple, right? Don't try to pick winners and keep investing in them in a staggered manner.
All right, so that's take coming in with respect to how you should pick your counters within the quick commerce space. But Sunil, I was interested to know that what about the defense pack? Because of late we have also seen very good moves once again starting in the defense counters. Well, of course, we have seen good numbers rather coming in from some of the majors like Bharat Electronics. But given the growth outlook, picking all at once, will that be a good strategy?
I think picking all at once will be a good strategy, but I would like to add a small rider here. And there, if you see, what's happened is the story of defense in India, and especially if you look at the Defense Nifty Index, is of the public sector. right? Because 70 to 80% of the Nifty Defence Index is public sector companies. And because they are beneficiaries of government orders, because the Atmanirbhar Bharat program has played a large way through them, and the Indo-Pak war has meant we used up a lot of our ammo and ammunition, and so we need to fresh orders and modernizing. Yes, but the new emerging story there is not just the PSUs. The new emerging story is of the private sector defense in the new age warfare, the drones, the UAVs, right? And there they demonstrated their success brilliantly during the Indo-Pak conflict. And post that, what we have seen is a huge rise in the order book for these companies from not only Asian countries, but I understand even Europe, where because of America's kind of shunning NATO, each of the European countries is looking to build their own defense stockpile now on their own, not just relying on an America-funded NATO. So because of which now their defense budgets are going up and they're all interested in the new age warfare. And so the Indian defense export story is going to be a huge, it's about 22,000 crores now. The next 5 years, I see it going to 50,000 crores. So with that kind of a growth, I would say build a diversified defense portfolio, but allocate half to the public sector and allocate half to the private sector, and keep some amount of cash for newer private sector which are not yet in the stock market, will come and list in the next year or 2 years. So my story is the same, right? But this time I'm saying put an equal weightage to private sector defense along with public sector, right? The valuations are already pretty stiff. So my other philosophy of diversify and stagger investments sticks even here. But like I said, here I just want the mix to be a little bit increase towards the private sector and make it 50-50 between private sector defense and public sector defense.
Okay, all right. Some of the other movers, and let's talk about those, is Atul Auto, which is up 8.7% in trade. Kunal, of course, numbers came out. The numbers looked decent, I believe, Srishti. And but what is it looking like on charts? This 8.5% move on an Atul Auto.
So I frankly don't track the stock very closely, but then I think looking at the charts over the last 1 month, 1 or 2 months, specifically the month of September and October, I think there have been many days when the stock was up, 5-10% broadly for consecutive days. But then largely the stock has been more range bound in the last 2 or 3 months or so. 420 has acted as a major support for the stock, but on the higher side, we've seen a sort of a strong resistance at 540 mark for Atul Auto. So really a stock which I believe could largely be into this broad 20-25% kind of a range. 420 as a support and 540 as a resistance.
And what about the defense counters? We just spoke about them on the fundamental side. MTAR Tech is one which is up 6.5%, one of the top gainers on the BSE 500, I believe. And there's also Latent View doing very well for itself. In fact, there's a bunch of defense counters which are doing very, very well. Latent View, not a defense counter per se. But let's talk defense first. Give us a sense of how's it looking. Yesterday also defense was a big gainer. Today also up 2.5%.
So there's a definite tilt which has now come back into the defense names. It started off with HAL, I think, yesterday, and BEL start to show signs of strength. And then I think that slowly and steadily trickled into the other names. Then Bharat Dynamics, you saw BEML, in the shipping names, GRSC, Massgondock, etc. They start to look fairly attractive. And now I think you've seen the other names also start to participate, rights, etc., which have started to look attractive in terms of the last couple of days of price move. But largely you have to understand that this is a very strong major long-term uptrend which you are seeing for the entire defense names. Within this pack, there have been multiple stocks which have different characteristics. For example, BEL is one of the more formidable names, relatively low beta stock from the rest of the stocks in the defense pack, large cap names of course. I think the stock has shown signs of absolute stability over the last many weeks and months of the markets being volatile in many phases. HAL over the last, I think, 1 or 2 months, the correction was a little bit more on the steeper side when the stock had come back towards, I think, 4,200, 300 kind of a mark. That was a bounce back towards its long-term moving averages or a mean reversion. That stock also looks attractive now at current levels. So it's really, I think, a play over here that how many stocks which you're looking to buy from the defense pack, because many of these stocks are poised at a different juncture. You have these shipping names, for example, Massgondock, GRSC, etc., which are still way off from the 2024 highs. So I think that's also another play which one could look at in terms of pure classic risk reward, and especially with a time frame of 18 months or so.
And with that, we hit the day's high as well, Kunal. 25,705. Yeah, so days high. Let's take bets. When do we hit all-time high?
So I think going by the pace, we should be closer to the all-time highs. Maybe 26,000 is where we discussed yesterday. So I'll probably revise it to 26,200 thereabouts for the Nifty. But my sense is that potentially next week we should be closer to 26,000, 26,200 levels.
All right, interesting. But Sunil, do you concur with that view that all-time high is nearby and we could hit those levels anytime soon?
Well, I think it all lies in the hands of one person, Donald Trump. Right? He needs to follow through with repeated Truth Social tweets about we are close to a deal, and great friend of Mr. Modi, great friend of Mr. to actually get a deal signed. And the day that deal is signed, even if it is a partial deal or an interim deal or a phase one deal, the markets will easily cross their lifetime highs because we are so close to it. And FII flows have been dragging it down. One small trade, even if FIIs really don't come in as big buyers, but they stop their selling, the market can hit a lifetime high. So, like I said, picture of Mr. Trump, and keep looking at that and wait for him to actually sign on the dotted line instead of just saying it's coming, and let it come.
Okay, Sunil, thank you so much for joining us this afternoon, giving us all of those views. We'll let you go on that note. It's been a fun conversation. And thanks so much once again. Well, we are continuing to sit at intraday highs.